What if everything you have been told about gold and silver was only half the story? Not the wrong story. Just half of it. Because here is what most financial content will not walk you through. The part that happens before the big move. The quiet, uncomfortable, almost invisible phase where prices do the exact opposite of what logic says they should. Where smart-sounding headlines tell you the trade is over. Where the majority of investors give up or sell. And then something shifts. And the people who understood the pattern are already positioned. And the people who did not are left watching from the outside. In this video, we are going to explore a question that a growing number of economists, independent analysts, and even central bank watchers are quietly asking right now. Could gold and silver be approaching one of the most significant structural turning points in a generation? We are not going to make predictions. We are not going to tell you what to buy. What we are going to do is walk through the mechanics, the historical patterns, the macro forces, the signals that have appeared before major moves in the past. And we will let you decide what it all might mean. This is Green Planet Digital. We explore wealth building and sustainable living for working professionals who want to grow their money without losing sight of the kind of world they are building it in. If that sounds like you, stay with us. This one is going to be thorough. And one more thing before we dive in. Everything in this video is for educational and informational purposes only. Nothing here is financial advice. Always do your own research and consult a qualified financial advisor before making any investment decisions. We mean that genuinely. Right. Let us get into it. Let us start with something that confuses almost every new investor when they first encounter it. When the world feels the most unstable. When there is geopolitical tension. When inflation is rising. When currencies look shaky. Most people expect gold to immediately go up. And sometimes it does. But very often, at least in the early stages of a crisis, gold actually drops. Does that sound backwards to you? If so, drop the word pattern in the comments right now. Because once you understand why this happens, you will never look at a gold pullback the same way again. So why would gold fall during a crisis? Let us walk through the mechanics step by step. Step 1. A major economic or geopolitical shock occurs. It could be conflict somewhere in the world. It could be a currency crisis. It could be a shock to the oil supply. Something big and disruptive happens. Step 2. When oil prices spike or supply chains are disrupted, inflation expectations rise. Not necessarily actual inflation yet, but the expectation of it. And in financial markets, expectations often move prices faster than reality does. Step 3. When inflation expectations rise, central banks, particularly the US Federal Reserve, feel pressure to keep interest rates higher for longer or even raise them. They cannot be seen to be fueling inflation. So rate cuts get delayed. Rate hikes become possible. The cost of money goes up. Step 4. When interest rates or bond yields rise, suddenly assets that pay you a return, like government bonds or money market funds, become relatively more attractive. If a US Treasury bond is paying you 4 or 5% per year with very low risk, and gold is sitting there paying you nothing at all, where do institutional investors, pension funds, and large money managers move their capital? They move toward the thing that pays them something. At least in the short term. Step 5. As capital flows into US Treasuries, demand for the US dollar rises. The dollar strengthens. And here is where it gets interesting. Because gold is priced in US dollars globally. So when the dollar gets stronger, gold prices in dollar terms often fall, even if nothing fundamental has changed about gold itself. It is not that gold got weaker. It is that the dollar got relatively stronger. Step 6. On top of all of this, you get institutional selling. Large funds that are sitting on significant paper profits from a prior gold rally will often take profits during volatile periods. They use gold as a liquid asset they can sell to raise cash when other parts of their portfolio are under stress. So you get the dollar rising. Bond yields rising. Institutional profit-taking. And suddenly gold is falling sharply, right at the moment when every news headline is screaming about global uncertainty. And the retail investor who bought gold precisely because they were worried sees the price drop and panics. They either hold and feel terrible, or they sell at a loss. Now here is the question worth sitting with. Is that the end of the story? Or is that just phase one of a much longer pattern? Because when you go back through the historical record, a case could be made that this exact sequence, the initial drop, has appeared before what many analysts would later call significant multi-year gold bull markets. We are going to explore that history in detail in just a moment. But first, drop pattern in the comments if this mechanical explanation is clicking for you. And if you want a structured breakdown of these macro forces plus a wealth planning tracker built specifically around commodity cycles, comment the word toolkit and we will send you the link to our resource in Green Planet Digital Store. Let us go on a brief historical tour. Not to predict the future, but to understand what kinds of environments have historically preceded major gold and silver moves. We are going to look at 5 distinct periods. And in each one, we will note what the setup looked like before the move. The early 1970s. This is the period where the United States formally ended the convertibility of the dollar to gold. What had been a fixed exchange system for decades was dismantled. For years after that decision, gold traded in an environment of enormous uncertainty. There was an oil embargo. Inflation rose significantly. The dollar weakened substantially versus other major currencies. Could this environment have contributed to what some economists describe as one of the great gold bull markets of the 20th century? That seems plausible. Gold went from being administratively fixed to trading freely, and prices moved dramatically over the following years. The late 1970s. Oil production disruptions in a major producing nation created enormous energy price shocks. Inflation in the United States and across Europe reached levels that many people had considered impossible just years earlier. Central banks were caught between slowing economies and rising prices, what economists call stagflation. In that environment, the question of whether gold serves as a store of value became very relevant for a lot of institutional and retail investors simultaneously. What happened to gold prices in that period is well documented. The early 1990s. A major conflict in the Middle East disrupted oil markets once again. Defense spending increased. Government deficits in many countries widened. Gold had a meaningful short-term spike during the conflict itself, but the more interesting story is what happened to precious metals over the decade that followed as monetary policy evolved and new global financial structures were built. The early 2000s. A combination of a technology stock market collapse, geopolitical conflict, and the beginning of what many analysts call a structural shift in U.S. fiscal policy, meaning the U.S. went from budget surplus to significant deficits, coincided with the start of what became a prolonged multi-year gold bull market. Gold was trading at prices that, adjusted for inflation, represented historical lows. Over the following decade, it rose substantially. The 2010s and 2020s. The global financial crisis of 2008 and 2009, followed by an era of unprecedented monetary expansion by central banks around the world, zero and near-zero interest rates, quantitative easing, massive asset purchase programs. Gold rose through much of this period. Then rates rose. Gold pulled back. Then a pandemic hit, rates went to zero again, monetary expansion accelerated, and gold hit new all-time highs. Now here is what is worth noting across all of these periods. In each case, there was a period of confusion or disappointment before the move. A period where the headlines were negative. Where the obvious trade did not seem to be working. Where a lot of retail investors either gave up or had not yet noticed what was building. Could that be what is happening right now? We genuinely do not know. No one does with certainty. But the question seems worth exploring. Drop the word history in the comments if you found this historical context useful. And if you are someone who wants to understand how commodity cycles might interact with your personal wealth planning, comment the word toolkit below. Every market cycle has similarities to past cycles. Every market cycle is also different. So let us spend some time on what appears to be genuinely new or different about the current environment for gold and silver. The first thing worth noting is central bank behavior. For most of the period between roughly 1990 and 2010, many Western central banks were actually selling gold from their reserves. The view at the time was that gold was a relic. That modern monetary systems did not need it. That there were better ways to hold reserves. That behavior appears to have shifted meaningfully. Over the past several years, central bank gold purchases have been running at some of the highest levels in recorded history. Who is buying? Primarily central banks in emerging markets. China, India, Turkey, Poland, several Gulf nations, and others. Now, why might that matter? Central banks are not buying gold because they expect to make a quick profit. They are buying because gold is one of the only reserve assets that is no one else's liability. It is not a promise from a government. It cannot be frozen by a foreign power. It cannot be sanctioned away. In a world where geopolitical tensions between major powers appear to be structurally rising, that property of gold may be becoming more relevant to reserve managers than it was in the relatively stable decades of the late 20th century. Is this a decisive signal? Not necessarily on its own. But it is a data point worth understanding. The second thing that seems different is the scale of global debt. Total government debt across major economies, the United States, Europe, Japan, China, and others, is at levels relative to GDP that have historically been very rare in peacetime. The US national debt alone is approaching levels that some economists argue become increasingly difficult to service without either very high growth, significant inflation, or some form of restructuring. What does this have to do with gold and silver? Well, one school of thought argues that when debt levels reach these extremes, governments face an almost structural incentive to allow or even engineer higher inflation over time. Because inflation, painful as it is for savers, is actually a way to erode the real value of outstanding debt. You borrow $1, inflation reduces what that dollar buys, and you effectively repay less in real terms. If that school of thought has merit, and it is a legitimate perspective held by serious economists, then assets that historically have been considered inflation hedges, gold, silver, certain real assets, might be worth considering as part of a long-term portfolio. The third thing worth noting is the silver story specifically. Silver is often called the poor man's gold. But silver is also a deeply industrial metal. It is used in solar panels, in electric vehicle batteries and components, in electronics manufacturing, in medical devices, in water purification. And here is a question worth sitting with. If the world is on a trajectory toward renewable energy build-out on a large scale, which most major government policy frameworks suggest it is, what does that mean for the industrial demand for silver? Solar panels require silver. Wind energy infrastructure requires silver. The electrical grid upgrades needed to support electric vehicles require silver. If industrial demand for silver is structurally rising at the same time that silver is being considered as a monetary metal in a world of currency uncertainty, what might that combination do to the supply-demand balance over a multi-year period? We are not predicting. We are just noting that the structural demand picture for silver, unlike many other metals, seems to have both an industrial and a monetary dimension simultaneously. That is somewhat unusual. Drop the word silver in the comments if the industrial demand angle for silver is something you want us to explore in a future dedicated video. And if you want to track your own precious metals exposure alongside your broader investment portfolio, comment toolkit for the link to our planning resource. Here is a topic that tends to get either dismissed or overhyped, depending on who you are talking to. The question of what happens to the US dollar over the next decade or two. Let us try to look at this as objectively as possible, because it matters enormously for gold and silver. The US dollar has been the world's dominant reserve currency since the end of World War II. That means most international trade is priced in dollars. Most commodity markets are priced in dollars. Most central bank reserves are held in dollar-denominated assets. This is an enormous structural advantage for the United States. But several trends are worth watching carefully, even if their ultimate impact is uncertain. First, a number of countries have in recent years been exploring or actively pursuing bilateral trade arrangements in non-dollar currencies. China and Russia have been particularly active in this regard. Saudi Arabia, historically a firm dollar ally, has publicly explored pricing some oil in alternative currencies. India has conducted trade in rupees with several partners. These are small percentages of global trade today. But the direction of travel seems noteworthy to many observers. Second, the weaponization of the dollar, meaning the use of dollar clearing access as a sanctions tool, which reached a very visible peak with the freezing of Russian central bank reserves in 2022, has raised a question that many non-Western central banks are now actively studying. What happens to us if we hold our reserves primarily in a currency controlled by a geopolitical rival? That question has no easy answer. But it seems to be driving incremental diversification into gold. Third, and perhaps most importantly for the long term, is the question of whether the United States' fiscal trajectory is consistent with long-term dollar strength. Historically, currencies have weakened when the issuing government runs persistent large deficits, accumulates very large debt burdens, and does not have a credible path to fiscal stabilization. Whether the US is in that situation is genuinely debated. But the debate itself is now happening among mainstream economists, not just gold bugs. None of this means the dollar is going to collapse. That is not the argument being made here. The dollar is an extraordinarily entrenched institution with enormous network effects. Reserve currency status does not disappear quickly. But could there be a gradual, multi-year process of modest dollar weakening that benefits gold and silver? That seems like a scenario worth at least modeling in your financial planning. Comment the word currency in the comments if you want us to do a deep dive into the dollar and its long-term outlook in a future video. That would be a fascinating one to explore together. Let us shift from the macro level to something more personal. How do gold and silver actually fit into a real person's investment portfolio? First, a framing point. Gold and silver are not the same type of asset as a stock or a bond. A company stock gives you ownership in a business that is producing goods or services, generating revenue, hopefully growing over time, and potentially paying dividends. A bond gives you a contractual promise to receive interest payments and return of principal. These are income-producing, cash flow-generating assets. Gold and silver do not produce income. They do not pay dividends. They do not have earnings reports. They are what economists call a store of value. Their theoretical purpose in a portfolio is not necessarily to grow your wealth the way a business grows, but rather to potentially preserve the purchasing power of wealth against inflation or currency debasement over time. That distinction matters because it changes how you might think about sizing a position. If you put 80% of your portfolio into gold and silver and they remain flat for a decade, you have missed out on compounding in productive assets. If you hold zero gold or silver and inflation or currency weakness significantly erodes purchasing power, you may wish you had some form of hard asset exposure. Most traditional financial planning frameworks that include precious metals suggest an allocation somewhere between roughly 5% and 15% of a portfolio, depending on risk tolerance, time horizon, and macroeconomic views. Some more aggressive portfolio managers go higher. Some say zero is fine depending on the individual's situation. The right answer for you specifically is something to discuss with a qualified financial advisor who knows your full situation. But understanding why people hold these assets, what role they are supposed to play, is an important part of making an informed decision. Now within the precious metal space itself, there are also meaningful choices about how you gain exposure. Physical gold and silver. Coins, bars, or other physical forms. The advantage is that you own something tangible with no counterparty risk. The disadvantage is storage, insurance, and the practical challenge of liquidating when needed. ETFs and exchange-traded products. Funds that hold physical gold or silver on your behalf. More liquid, lower storage burden, but you are dependent on the fund structure and its custodians. SPDR Gold Shares, iShares Silver Trust, and similar products are among the most common in the US and European markets. There are also ESG-screened precious metals funds emerging for investors who want to consider the sourcing and environmental practices of the underlying metals. Mining stocks. Companies that explore for, extract, and process gold and silver from the ground. These offer a different risk and return profile than owning the metals directly. When metal prices rise, the profit margin of a well-run mining company can expand significantly because their costs are relatively fixed but their revenues rise with the metal price. This is often described as operating leverage. But mining stocks also carry company-specific risks, operational risks, political and regulatory risk in the countries where they operate, and management quality risk. Royalty and streaming companies. These are a somewhat different business model. Instead of mining themselves, royalty companies provide financing to miners in exchange for the right to receive a percentage of future production at a predetermined price. This gives them exposure to precious metals with less operational risk than owning a mine. Names like Royal Gold, Wheaton Precious Metals, and Franco-Nevada are examples of this model in the global market. Each of these approaches has merit depending on your situation and risk tolerance. Drop the word mining in the comments if you would like us to create a detailed educational video specifically on how gold mining companies work and how to think about evaluating them. Here on Green Planet Digital, we always want to connect the financial picture to the broader picture. And precious metals are actually a fascinating case study in responsible investing. Because mining, let us be honest about this, has a significant environmental footprint. Extracting an ounce of gold requires processing enormous quantities of rock and earth. It uses significant amounts of water. It produces tailings, which are the waste materials left after processing. And historically, some mining operations have had very poor records on environmental management and community relations. So if you are someone who cares about where your money goes and what it supports, how do you think about precious metals? A few thoughts worth considering. First, there are meaningful differences between mining companies on environmental, social, and governance dimensions. Some mining companies have invested heavily in reducing water usage, in land rehabilitation, in community benefit agreements, and in reducing their emissions footprint. Others have not. This is actually an area where doing your research on specific companies can make a real difference if you want to align your investments with your values. Second, the silver story has a genuinely interesting dual nature from an environmental perspective. On one hand, silver mining has environmental costs. On the other hand, silver is a critical input for solar panels, which are a cornerstone of the renewable energy transition. So there is an argument that producing more silver responsibly is actually necessary to enable a lower carbon energy system. That tension is worth thinking about. Third, recycling is a growing part of the silver supply picture. A meaningful and growing percentage of silver supply comes from recycled electronics, old photographic film, and industrial scrap. This reduces the demand for newly mined silver at the margin. And from a portfolio perspective, it also means supply is somewhat more diversified than it used to be. Fourth, if you want to hold gold or silver in a way that is more aligned with ESG principles, there are now several fund options specifically designed around responsible mining criteria. These are worth researching if the environmental dimension matters to you. At Green Planet Digital, we believe building wealth and being thoughtful about how that wealth is deployed are not in contradiction. They reinforce each other over the long term. Drop the word green in the comments if you want us to explore ESG screen precious metals investment options in a dedicated future video. This is a space that is evolving quickly and there is a lot worth discussing. We have covered a lot of ground. History. Macro forces. Portfolio structure. Sustainability considerations. Let us now talk about how thoughtful investors attempt to read signals in the gold and silver market. Again, we are not giving you a system to predict prices. No such system exists reliably. What we are doing is walking you through the types of data points that serious investors look at when they are trying to understand where we are in a precious metals cycle. Signal 1. The gold to silver ratio. This is simply the price of gold divided by the price of silver. Historically, the ratio has moved in a fairly wide range. When the ratio is very high, meaning it takes many ounces of silver to buy 1 ounce of gold, some investors interpret that as silver being relatively undervalued compared to its historical relationship with gold. When the ratio is lower, silver may be relatively more expensive versus gold. This ratio does not tell you when to buy or sell. But it does give you a sense of the relative valuation between the two metals, and some long-term investors use it as one input in their thinking. Signal 2. Real interest rates. We talked earlier about how rising rates can pressure gold. But the more nuanced measure is not nominal rates but real rates, which is the interest rate minus inflation. When real rates are deeply negative, meaning inflation is higher than the interest rate you can earn on safe assets, the opportunity cost of holding gold, which pays no yield, becomes very low. Many analysts argue there is a meaningful historical relationship between negative real rates and gold price performance. Signal 3. Central bank net purchasing. We already discussed this, but it is worth noting that it is trackable. The World Gold Council publishes quarterly data on central bank gold purchases and sales. It is publicly available. Watching whether net purchases continue, accelerate, or slow down over time is one input into understanding institutional demand. Signal 4. The behavior of the US dollar index. The DXY, or dollar index, measures the US dollar against a basket of major currencies. Because gold is priced in dollars, the dollar's strength or weakness is often inversely correlated with gold prices. Watching the trend of the DXY is one of the inputs many precious metals analysts track closely. Signal 5. Sentiment and positioning data. Markets are driven by both fundamentals and psychology. When almost everyone is bullish on gold and position data shows that the market is extremely heavily long, there is often less room for further upside in the near term and more potential for a correction. Conversely, when sentiment is very negative, when retail investors are selling and media coverage is bearish, that is often historically the environment that has preceded significant reversals. None of these signals works perfectly in isolation. But together they can give you a framework for thinking about where we might be in a cycle, rather than just reacting emotionally to the latest price movement. Comment the word signals in the comments if this framework is something you want us to build into a full educational series. That is actually something we have been thinking about putting together as a comprehensive course. We try hard on this channel to be balanced. And the honest truth about gold and silver is that smart, thoughtful people disagree significantly about their long-term role in a portfolio. So let us steelman both sides. The case for meaningful precious metals exposure. Fiat currencies, meaning currencies not backed by any hard asset, have historically tended toward debasement over long periods. Almost every major fiat currency of the last 100 years has lost significant purchasing power over time. Gold has maintained purchasing power over very long periods. If you believe the current era of large fiscal deficits and expansionary monetary policy is likely to continue, the argument for having some store of value outside the fiat system has some logic to it. Central banks, the most informed institutional actors in the monetary system, have been buyers of gold in recent years, not sellers. That is at minimum a data point worth noticing. Silver has a structural industrial demand story, linked to the energy transition, that is relatively independent of the monetary argument. Even if you are skeptical about gold as a monetary metal, the industrial demand case for silver over the next decade seems worth considering on its own merits. Portfolio diversification. Gold has historically shown low or negative correlation to equities during certain market stress events. That means adding some gold to a portfolio of stocks and bonds has, in some historical periods, reduced overall portfolio volatility. The insurance analogy is used often. You hope you never need it. But you are glad it is there if you do. Now the case against overweighting precious metals. Gold and silver do not generate income. Over very long periods, quality businesses represented by diversified equity indices have significantly outperformed gold. If you had put the same amount of money into a broad S&P 500 index fund versus gold in 1990, the equity index would have outperformed significantly, even accounting for gold's recent price increases. Productive assets compound. Gold does not compound in the same way. The costs of owning physical precious metals, storage, insurance, transaction costs, can add up over time and eat into whatever inflation protection benefit they provide. Gold's value is ultimately determined by sentiment and the collective belief that it is valuable. Unlike a business with earnings, there is no fundamental cash flow to anchor the valuation. This makes long-term price prediction particularly difficult. And the opportunity cost argument. Every dollar in gold is a dollar not in an income-producing asset. In a world where quality dividend-paying companies, REITs, and bond funds can generate meaningful ongoing income, the choice to hold a non-yielding asset always involves an implicit trade-off. Both sides of this argument have merit. The right balance is a personal decision that depends on your financial situation, your beliefs about the macroeconomic environment, and your long-term goals. If you are working through these questions and want a structured framework to help you think about portfolio allocation across different asset classes including precious metals, comment toolkit below and we will send you the link to our resource. If after everything we have discussed today, you are thinking about exploring precious metals as part of your financial picture, here are some practical, sensible steps worth considering. This is not a recommendation. It is a framework for how a thoughtful person might approach this. Step 1. Educate yourself on the different ways to gain exposure. Physical metals. ETFs, mining stocks. Royalty companies. Each has a different risk and return profile. Understanding the differences before you invest is important. Step 2. Consider your time horizon. Precious metals have historically rewarded patient, long-term holders much more reliably than short-term traders. If you cannot commit to holding through significant short-term volatility, a large allocation may not be right for you emotionally, even if the fundamentals are compelling. Step 3. Think about position sizing carefully. Most balanced portfolios that include precious metals tend to keep the allocation relatively modest. Adding some precious metals exposure as a diversification and inflation hedge is quite different from making it a dominant part of your portfolio. Step 4. Consider dollar cost averaging rather than trying to time the market. Given how difficult it is to predict short-term price movements, some investors prefer to invest a fixed amount at regular intervals. This smooths out entry price over time and removes the psychological burden of trying to pick the perfect moment. Step 5. If you are in the US, understand the tax treatment. Precious metals ETFs and physical metals are often treated as collectibles for tax purposes in the United States, which can mean higher capital gains rates than for equities. This is worth understanding before you invest. Step 6. If you want ESG-aligned exposure, research responsible mining funds or look at the ESG ratings and environmental practices of any mining stocks you are considering. Some fund providers now offer products specifically screened for responsible sourcing and environmental management. Step 7. Talk to a financial advisor. We cannot say this enough. A qualified advisor who knows your full financial picture is in a much better position to advise you on whether and how precious metals fit into your specific situation than any YouTube video. Comment steps in the comments if this practical framework is useful. And remember, if you want our structured planning resource to help you work through these decisions in a systematic way, just comment toolkit and we will send you the link. Here on Green Planet Digital, we always zoom out at some point in every video. Because wealth building does not happen in a vacuum. It happens in the context of your life, your values, and the world you are building toward. There is something philosophically interesting about gold and silver that goes beyond their price charts. They are among the oldest stores of human value on the planet. Gold has been used as a medium of exchange and store of wealth for thousands of years, across almost every human civilization we know of. That is a remarkable record of trust. Not perfect. Not without its own ethical complications, particularly around the history of mining and resource extraction. But remarkable nonetheless. And in a world that is becoming increasingly digital, increasingly abstract, increasingly mediated by financial instruments and technology layers, there is a certain appeal to an asset that you can hold in your hand. That does not depend on a server being online. That does not require trusting a counterparty. That has intrinsic physical properties, conductivity, reflectivity, malleability, that make it genuinely useful across millennia. Whether or not gold and silver make sense in your investment portfolio is ultimately a financial decision. But it is a decision worth making thoughtfully, with full information, rather than either dismissing it as old-fashioned or embracing it uncritically as some kind of guaranteed protection against everything. The world is complex. Financial markets are complex. The honest answer is that no one knows exactly what happens next. What we can do is try to understand the forces at play, the patterns that have appeared historically, the risks and opportunities on both sides, and make decisions that we can feel genuinely confident about. That is what Green Planet Digital is about. Not certainty, but informed, thoughtful decision-making. For your money and for your world. Let us bring it all together. Today we explored the mechanical reason gold often falls before it rises during a crisis. We walked through roughly 50 years of historical patterns where this sequence has appeared to play out. We looked at what might be genuinely different in the current environment, from central bank buying to the structural industrial demand for silver in a clean energy transition. We explored how gold and silver might fit into a portfolio, and how to think about them from an ESG perspective. And we walked through practical steps for anyone curious about this space. Here is the honest takeaway. Could gold and silver be approaching an important moment? That is a plausible interpretation of the data. Could prices also remain flat or fall further before any significant move? Absolutely. Markets do not follow scripts. Anyone telling you otherwise should probably be approached with healthy skepticism. What we do think, and this is where we will always land on this channel, is that understanding these dynamics, the macro forces, the historical patterns, the different ways to participate, makes you a more informed investor. And informed investors make better decisions. Not perfect decisions. Better ones. If you want to go deeper, here is what we have for you. First, if you comment the word toolkit in the comments below, we will send you the link to Green Planet Digital's wealth planning resource. It is a structured tool to help you think through asset allocation, inflation hedging, and long-term portfolio construction in a systematic way. You will find the link in the pinned comment. Second, if you found this video valuable, please hit the like button. It genuinely helps more people find this content. And if you want to go deeper on topics like this, the subscribe button is right there. We put out educational content on wealth building and sustainable living for working professionals regularly. Third, we would love to hear from you in the comments. Were you already thinking about gold and silver? Are you skeptical? Do you have questions about something we covered? Drop your thoughts below. We read them and they genuinely shape what we create next. And finally, one thing we always say on this channel. Build wealth deliberately. Tread lightly on the planet. And live on your own terms. We will see you in the next one. This video is for educational and informational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Past performance of any asset class is not indicative of future results.